The following material is for educational purposes only. It is not an investment recommendation, and past performance does not guarantee future results. Most people understand the FICO score as a 3-digit number used to gauge personal creditworthiness. In reality, it is a legally mandated toll booth, placed at the center of the United States credit system. Every time a home is purchased, refinanced, or a mortgage is packaged into a security to be sold to investors, FICO extracts a fee. Operating this infrastructure has generated a 26% compound annual growth rate, or CAGR, in earnings per share over the last 10 years. CAGR measures the mean annual growth rate of an investment over a specified period longer than 1 year, and earnings per share, or EPS, is the portion of a company's profit allocated to each outstanding share of common stock. This rate of compounding is typically reserved for aggressive, early-stage software startups scaling a new technology, not a 70-year-old financial utility. A mature legacy business is producing startup-level returns without launching a revolutionary consumer product or expanding into massive new markets. FICO is an intellectual property monopoly hiding in plain sight as a mundane financial metric. This market dominance was methodically built across 3 distinct historical acts. Act 1 spans from 1956 to 1989. 2 Stanford mathematicians founded the company, eventually releasing the 300 to 850 scale that became the industry standard for measuring consumer default risk. Act 2 began in 1995, when Fannie Mae and Freddie Mac, the government-sponsored enterprises that buy and guarantee mortgages, officially mandated the FICO score for mortgage securitization. Without a FICO score, a loan cannot be securitized. Securitization is the process of pooling various types of contractual debt and selling their related cash flows to third-party investors as securities. Because of this mandate, the 30-year American mortgage market cannot function without FICO. Act 3 started in 2012 under CEO Will Lansing. Lansing leveraged this captive market to trigger aggressive price increases for the score, while pivoting secondary operations towards cloud-based software. Those strategic decisions shaped the current corporate structure of the business. This chart shows FICO's $1.99 billion in revenue across 2 segments. The score segment generated $1.16 billion in 2025, 59% of total revenue. The software segment provides the remaining 41% at $822 million, functioning as a secondary growth engine. The legally mandated cash flow from the scoring system funds the incubation of a modern software-as-a-service platform. FICO is a pure intellectual property licenser rather than a data aggregator. The company does not own or store consumer financial data. It provides the mathematical algorithm used by the credit bureaus. This chart illustrates the result of that licensing model, an 88% operating margin within the score segment. This margin has remained stable over the last 7 fiscal years, having effectively reached its theoretical maximum. Because the revenue is pure royalty income, there is virtually zero marginal cost to produce an additional credit score. Once the algorithm is developed, revenue scales without requiring additional raw materials, labor, or production costs. The business is a highly optimized form of royalty extraction. To see how these royalties accumulate, we have to look at the actual life cycle of a mortgage transaction. This infographic maps the mortgage value chain, tracking a loan from the initial data pull to the final providers of capital. The first stage is shopping. A borrower's request for a pre-approval immediately triggers the first credit check. Stage 2 is origination and closing. The lender orders a tri-merge report, which consolidates data from Equifax, Experian, and TransUnion. Pulling a single tri-merge report requires 3 separate FICO model consultations for an individual, or 6 for a couple. In Stage 3, Fannie Mae and Freddie Mac require an updated FICO score before the loan can be packaged into a security for investors. Stage 4 is monitoring. Loan servicers check the borrower's credit annually even after the loan has closed, generating recurring pulls. A single home purchase generates up to 15 separate pulls across different entities. The $495 fee represents less than 0.05% of a $10,000 transaction cost, making the price effectively invisible to the participants. FICO has successfully placed a toll booth at every single intersection of the mortgage value chain. Having captured 90% of the market, the company must rely on specific financial levers to continue growing its earnings. This chart breaks down the projected earnings growth from the 2025 base out to the 2030 projection. The first growth factor is pricing power. FICO increased the price of a mortgage score from 50 cents in 2018 to $4.95 in 2025. The second vector is cyclical volume. Mortgage originations are currently in a trough due to high interest rates, creating significant upside if rates drop and refinancing activity increases. The third vector is the software pivot. The FICO platform currently maintains a 112. Net retention rate is a metric that measures the percentage of recurring revenue retained from existing customers over a set period, including any expansion from upsells. The final lever is share buybacks. Aggressive share reduction concentrates profits among fewer shares, increasing the final EPS figure. Future earnings are being actively engineered through a masterclass in pricing leverage. CEO Will Lansing manages the business with a disciplined approach to capital allocation. Lansing has avoided destructive acquisitions since 2012, recognizing that the core business already possesses an unassailable advantage. He deploys free cash flow and debt leverage to buy back stock, which has reduced the total share count by 25%. A regulatory change in late 2025 will require lenders to accept both FICO 10T and VantageScore 4.0. VantageScore is a required addition rather than a replacement. FICO remains the predominant backbone of the securitization market. Extracting the FICO algorithm from the financial plumbing of thousands of lenders would require redesigning entire systems, creating insurmountable switching costs. FICO functions as a legally mandated toll bridge over the flow of American capital, deeply embedded in the financial plumbing of the global economy.